The core challenge of perfect timing is clicking after the breakout has already faded, with a shrinking bullish candle and declining volume while the gaze locks on the highs and the breathing turns shallow at the decision second. Another frequent trap is a sudden volatility burst that widens the spread on the retest, pushing reactive stops as the pulse spikes and the posture stiffens after late entries. This pain comes from stacking too many indicators and skipping a clear impulse rule which confuses noise with real momentum. Without predefined position sizing and a realistic risk versus reward, execution becomes reactive and the click happens when the market has already moved. Rule #1 is timing over participation. Validate a close near the extreme with rising volume, spread under control, and a shallow retest that holds risk before committing. Decide position sizing first. Align a minimum 1 to 2 risk versus reward, keep breathing steady, and track the candle behavior instead of chasing what just happened. Apply the same logic to scalping, day trade, and swing trade by adapting the entry point to the current volatility, not by automating context. This video delivers the most direct and precise way to nail the entry moment, filtering weak breakouts and sharply reducing late trades. Expect cleaner execution, tighter control of risk, and higher operational consistency across different market conditions. Subscribe now to master perfect timing and never miss a crucial move again. Your capital deserves expert protection today. Stay to the end to discover the only checklist that can turn your trades into consistent wins. A valid impulse starts with a candle that has a dominant body and closes at the extreme, with a range larger than the average of the last 2 or 3 bars, and increasing volume over the recent average of the observed period. The spread should remain stable during the breakout, without abrupt widening at the moment of the click. Volatility must be compatible with the asset and time of day, avoiding weak liquidity scenarios that distort the price. In a buy, the reading is a close near the high and the absence of a significant immediate retracement. In a sell, the opposite. The goal is to separate movement with the intention of advancement from noise of a microtrend that only captures short stops. To confirm intention and avoid a false breakout, observe if the price holds above half of the impulse bar after a shallow retest, with volume that does not collapse and spread that does not widen excessively. Rejections with long shadows and increasing reverse volume signal exhaustion, not continuation. In day trading, validate continuity beyond the initial range of the day with confirmation candles and no increase in opposing aggression. In swing trading, prioritize the breakout of a visible base on the daily or weekly chart with a close outside the congestion and without an immediate return to the range. In scalping, microstructure plays a greater role, but the logic remains the same. Close at the extreme, hold the retest, and don't allow spread widening at the trigger. The execution only occurs when these elements converge, maintaining stable breathing and focusing on the trigger candle to avoid premature action without confirmation. The stop is technical, placed below the low of the retest in a buy or above the high of the retest in a sell, and the position sizing is defined before the order based on fixed monetary risk. The minimum risk versus reward ratio is 1 to 2, adjusting the target to the first point of imbalance or obvious liquidity region. If the spread widens or the volume fails to confirm, the entry is cancelled without question. This standardization filters out late entries and keeps timing aligned with Rule #1, with participation subordinated to the quality of the impulse. A breakout with a shallow retest occurs when the price breaks a support or resistance level, pulls back slightly to test the same level, and then moves forward again in the direction of the breakout, offering confirmation and a better operational entry point. The purpose of the retest is to validate the role reversal of the level and reduce the chance of a false breakout before execution. The priority technical reading is a decisive breakout, a controlled pullback to the broken level, and a resumption of flow in the direction of the movement, supported by volume and without clear signs of level rejection. Avoid triggering on the first expansion peak, and wait for the retest to differentiate true momentum from noise and avoid late entries. The logic applies to different time frames and asset classes, maintaining consistency across short and long-term trades. Execution trigger entry, when the retest holds the level, and there is a renewal of flow with the breakout of the micro-high of the retest, accompanied by volume that sustains continuity. The technical stop is placed just below the retested level in buys or above it in sells, preserving the structure and invalidating the thesis only when the level loses its function. Define position sizing before the order with constant monetary risk per trade to standardize exposure and withstand losing streaks without compromising capital. Require a minimum risk versus reward of 1 to 2 and adjust the target to the next point of imbalance or an obvious liquidity region to maintain an asymmetry favorable to the plan. If the spread widens on the retest or confirmation, treat it as a higher execution cost and risk, and cancel the entry to protect the average price and hit rate. In scalping, prioritize a breakout of a micro range with a retest that occurs in a few bars and without spread widening, preserving transaction cost and fill quality. In day trading, validate the break of the initial range with a controlled return to the level and a resumption of flow, avoiding triggering while there is clear rejection from the opposite side. In swing trading, look for a breakout of a base on the daily or weekly chart with a retest to the top of the base and a close outside the congestion to prioritize continuity and reduce intraday noise. In all styles, accepting the retest reduces the probability of a false breakout and improves execution timing without relying on guessing. Monitor the volume behavior on the retest, as a volume collapse indicates a lack of conviction and invalidates the continuity reading of the movement. In scalping, the entry occurs at the breakout of a micro range with a shallow retest and a renewal of flow upon breaking the micro high of the retest, with a dominant body candle, immediate increasing volume, and a stable spread. The stop is technical, just below the low of the retest, and the position sizing is smaller to account for execution costs and possible slippage. The initial target aims for quick asymmetry with a minimum risk versus reward of 1 to 2, without extending if the spread starts to widen or if the candle loses its body. Cancellation is the rule when volume collapses on confirmation or when there is clear rejection at the level, preserving timing and avoiding chasing price. Controlled breathing and a fixed focus on the trigger candle reduce reactive clicks and keep rule number 1 in the forefront. In day trading, prioritize the breakout of the initial range with a close outside the range, followed by a retest that holds at the broken level and confirmation by a candle that renews the high with sustained volume. Execution happens at the breakout of the retest high, with a technical stop below the low of the retest and position sizing calibrated by intraday volatility. The initial target is set at the next visible point of imbalance, maintaining a minimum risk versus reward of 1 to 2, and add-on only occurs in evident strength after new price and volume confirmation. Cancel the entry if the price closes back inside the range, or if the spread widens on the retest to protect the hit rate and average price. A stable posture in decision-making prevents anticipation and preserves timing discipline in retests that take longer than ideal. In swing trading, the focus is on the breakout of a base on the daily or weekly chart with a close outside the congestion, a retest to the top of the base, and a resumption of movement with healthy volume and short rejection. The entry occurs when the high of the candle that validates the retest is exceeded, with a technical stop below the low of the retest or below the top of the base, accepting a larger distance to accommodate gaps. Position sizing is smaller to balance the wider risk, and the targets consider the next liquidity region, or the amplitude of the base, maintaining a minimum risk versus reward of 1 to 2. Partial exit at the first target, and trailing by structures of highs and lows protect capital without turning the trade into a hope-based operation. If the price loses the top of the base on a close, the invalidation is objective, and the exit is executed without hesitation to maintain consistency. Management begins with a partial plan and a standardized exit rule that preserves risk versus reward and prevents unnecessary retracement. Take partial profits at the first point of clear imbalance, such as the high or low of a recent structure, or the edge of the day's range, keeping the initial target aligned with a minimum of 1 to 2. The trailing stop should follow the price structure. Move the stop under the last pullback low for buys or above the last high for sells, only after a new pivot is formed. If the volume collapses during the resumption of the move or the continuation candle loses its body, reduce exposure to protect capital. A widening spread on confirmation increases the cost and reduces the hit rate. Treat this as a reason to freeze ads or shorten active management. The standardized exit rule considers loss of momentum and structural invalidation, not emotion. Objective criteria: close back inside the broken level, failure to renew the high or low after the retest, and a sequence of rejections with long shadows against the position. In buys, a loss of the base high on a close signals an exit. In sells, recovery of the lost level invalidates the position and requires an exit without hesitation. In high volatility environments, accept that the trail needs more space but do not sacrifice the minimum asymmetry of 1 to 2. In swing trading, include a daily or weekly close condition to exit, reducing intraday noise and maintaining consistency. Add-ons only occur in strength after new price and volume confirmation, with a controlled spread and without increasing the overall risk beyond the trade ceiling. After taking partial profits, move the stop on the remaining position to a protective point that ensures realized profit is not turned into a loss, preferably at break-even plus costs when the structure confirms. Avoid immediate re-entry after a stop if the level is congested. Wait for a new trigger with a dominant body candle and objective validation to keep timing aligned with rule number 1. In scalping and day trading, news and low liquidity times increase the risk of slippage, reduce position size or cancel execution when the spread is fluctuating. Monitor real-time metrics such as adverse and favorable excursions, the distance from the stop to the active target, and deterioration of flow and exit when the continuity reading is no longer present. Start with a short and objective pre-market routine. Define the fixed monetary risk per trade. Adjust position sizing to the expected range of the asset, and validate the hours of higher liquidity to reduce spread and slippage. Mark levels of interest and breakout scenarios with a shallow retest, clearly defining the invalidation point and target aligned with a minimum risk versus reward ratio of 1 to 2. Establish a volatility filter by time of day to avoid entries in noisy regions, such as wide opens without volume confirmation or low liquidity afternoons. Controlled breathing, a stable posture in the chair and a focused gaze on the trigger candle prevent premature clicks, and keep rule number 1 of timing at the center of decisions. If volume collapses during the retest or the spread widens at the trigger, the execution is canceled without discussion. During execution, document each trade concisely, screenshots before and after, reason for entry, type of trigger, volume condition and spread at the click. Record MAE, maximum adverse excursion, and MFE, maximum favorable excursion, to measure timing accuracy, effective slippage, adherence to the risk versus reward plan, and whether the technical stop respected the structure. In scalping, monitor microstructure and spread stability during the retest, avoiding entries when there is price fluctuation without consistent flow. In day trading, treat the initial range of the day as a reference and discard signals when the price returns inside the range after the retest. In swing trading, use daily or weekly close rules to validate breakouts and exits, reducing intraday noise and preserving trend reading. Post-market, conduct an objective feedback review with comparable metrics: entry hit rate by retest, average payoff in risk multiples, frequency of false breakouts, and difference between planned and executed risk. If drawdown exceeds the defined limit, apply an automatic reduction of risk per trade for a fixed set of trades, without altering the entry rule to compensate for losses. Perform replay training at a reduced speed, executing the same breakout with retest logic, and noting where timing failed due to hesitation or haste. Review whether add-ons were only made in strength, and if position sizing remained constant in unit risk, without scaling in weakness. The goal of the cycle is simple: adjust behavior so that rule number 1 guides all decisions, filtering out noise and keeping execution clean. Mastering rule number 1 in timing and risk management is essential to transforming the way you trade, bringing greater clarity and focus to execution. This practice reduces the noise of the market's indecisive movements, allowing the trader to make more solid decisions that are aligned with the plan, regardless of the chosen style, whether scalping, day trading, or swing trading. The direct consequence of this mastery is the creation of a more consistent operational routine, with less reactivity and more emotional control, where each entry and exit reflects an objective, well-founded criterion. By doing so, the trader minimizes exposure to sudden losses and strengthens the discipline that sustains longevity in the activity. Throughout the process, the learning becomes applicable in daily trading, with precise market reading, careful position sizing, and constant attention to risk versus reward. Performance improves when the trader learns to interpret real signals, rejecting false breakouts and respecting the volatility and liquidity of the asset. Progress is not instantaneous. It depends on continuous practice and critical analysis of one's own trades to adjust failures and avoid automatic error patterns. To enhance this journey, subscribe to the channel and activate notifications to be alerted at the right time about content that helps maintain firm decisions and protect capital under pressure. These notifications are important for integrating the study and application of the rules with the market rhythm, tracking the flow of real opportunities, and avoiding waste with dubious signals. Strengthen your discipline with daily practices that involve structured trade analysis, rigorous use of the trading journal, and constant review of results, always making adjustments based on evidence and concrete metrics. Keeping this focus turns any isolated trade into a solid, repeatable process. Closing this cycle with clarity reminds us that consistency is born from the combination of a precise methodology and self-control, where risk management sustains continuity and prevents impulsive decisions. True evolution happens when you understand that trading is not a sequence of bets, but the conscious exercise of technical control and rigorous discipline to navigate the market with more confidence.